Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate, with host Glenn Sutherland.
Welcome to another episode of A Canadian Investing in the U.S. This week my guest is Paul Bola. Paul has his own company, Realestatetofreedom. You know what, Paul? Let's give me a little intro on yourself and we'll dive into how you got started.
Okay. Thanks, Glenn. First of all, thanks for having me.
No problem.
I've lived in Canada for 5 years, so I'll go a little bit of my story, how that came out to be. But I've been born and raised in the U.S. and moved to Canada in 2014. Past lifetime, graduated engineering, did the right thing, as every Punjabi immigrant son would do, become an engineer and then get a good job. But went from there, got my MBA, and was really heavily into stocks, and I was looking into ways to grow my wealth. And like I said, I moved here 5 years ago. Yep. And what propelled me to that was a career opportunity here. I met my lovely wife that was from here, so we decided to make that move. And we started work, and as you know, living in the GTA, it's pretty expensive, right? And it's very hard to make it by when you look at just having a good career. And we sat together one time and just said, we've got two good careers here. A lot of stress, very busy. Again, cost of living in Toronto is very difficult, and at the end of the month, you're looking at we're scraping by. Yep. That social compact that we were told that get a good job after having a good degree, such forth, wasn't working for us. And we started looking at what other avenues can we do that, and it really came on to be to eventually go into real estate. That I could really see that we could make some money in. But when I look at where our portfolio was, got married to now, it's grown almost 10 times, which is amazing. And it comes down to that concept that if we were just saving money, saving equity, we would not gotten there. And we've gone through there through real estate, and then obviously with real estate you have the power of leverage, right? And with talking about those careers, I mean, it's just today, Glenn, we were texting, went to coordinate for this, and what's in the middle of that? It's our daily job, and obviously that's really controlling your time in your day, and that's why it's real estate to freedom. That's really the commodity is to gain time. As we have a family, I want to have more quality time with my kids and my family. Also looking at, when you're looking at careers, and this is a big part about real estate, is 50% of your wealth destruction, earned income, comes from taxes. When you look at income, sales taxes, all the taxes that you can add to the field to get to work, it gets around 50%. And real estate, look at that from a percentage perspective, it really reduces down because you have a lot of legal manners, way to reduce your taxes through tax deductions and tax credits. Part of a major reason why I wanted to move here from a financial side is that there was this large boom that I was seeing in Toronto, especially in Canada. There's a boom market that's going on. So if you look at it compared to year 2000, I wanted to ride that boom. So how to quickly gain our asset profile. And one thing I saw about Toronto that's very unique, I've said this before in other podcasts, it's literally like an island if you look at it. To the east, you have Lake Ontario, and to the west and a little bit northwest and southwest, you have the Greenbelt. And so you have a large concentration of people that can't really move outside of that, and you have a large influx of immigration that comes in, and most of them tend to stay in the GTA area. So, okay, that's going to increase demand, so property prices are going up. So that's still part of our portfolio strategy, is buying in the GTA and specifically like in downtown Toronto. I have a condo that will be closing up, pre-construction condo, closing up the end of this year, early next year, and that's still part of our equation to really build that asset profile. But what comes into play though as well, again, it's big about wealth strategy, is how do we take that equity that's gaining in the GTA or Southern Ontario and utilize it for today? So it's taking that equity from here and moving it, right? So we've done that, like just behind me, the wall here It's actually, it may be my house, but it's also my credit facility. It's a readvanceable mortgage. And we're moving that equity into the U.S. And, when you got price propositions that are about a third to a quarter of the prices here, and you have some great cash flow, it's a no-brainer. Myself, I keep a KPI index on all my properties, and it's very interesting when I look at one of my condos in Toronto that's around $400,000, and I get around $400 cash flow a month in Canadian dollars, and then I have a property in the Midwest that's getting around $50 to close to $400 US, less than 100,000. It's quite interesting, and when you look at those cash on cash or whatever metrics that you want to use, it's interesting, right? So.
Why does it not make sense to just leave equity in your house?
For example, the markets can change, right?
Yep.
If you look at 2017 and you look in the GTA, there was, I would say, a little bit of insanity in the markets. I look at a neighbor over there. They sold their house for $1.2 million for a 2,500 square foot home. It's not $1.2 million today, maybe about $1 million. But if you look at it from that perspective, that $200,000 went away, and you want to strike the iron when it's hot.
Yep.
You want to take that equity now and move it. And there's another thing too. When you use forms of debt capital like lines of credits or such forth like that, there's also a tax deduction for utilizing that as well. So even if you're using, it's at 3.5% or 4% after a tax deduction, it's going to be a lot lower for you. So that's actually a very good thing as well.
How'd this story go?
We bought some more properties into the U.S., right? We moved that equity there. We use that as down payments for properties down there. And then same thing, use the mortgage finance down there, and it's the power of leverage, right? If I can buy a property and put a down payment of, $20,000 or $30,000 US dollars, and I'm garnering a $350 to $400 cash flow, that's a big win. Because it comes to our wealth strategy where I want some components for our portfolio to grow up quickly. It's like buying stocks. You have some stocks that you want to appreciate up just from a stock value, then you want some from dividends. And again, it comes to freedom, and part of your freedom is garnering cash flow, right? We've got to use those debt capitals today to produce positive cash flow because, again, it's not going to work if we try to save. We're not going to keep up. And so part of our portfolio, we have an index where we're looking at income. So every quarterly, we have a quarterly review at the house. What we do is we look at all our assets, what our percentage of debt we have, like our percentage of LTV, and we see some things that, hey, we're at 50% LTV. Looking at it 2 weeks ago, and I realized that, we got about over $100,000 worth of equity that we have an opportunity to utilize to produce more income. So you got to, from my advice to any of the listeners here is constantly review your portfolio as if you're the portfolio manager, right? That's your wealth strategy. Are you really garnering that equity today? Because to answer that question that you asked earlier, Glenn, if you're not using your equity, you're losing, there's an opportunity cost on future cash flow. Right?
Yep.
So you got to seize the moment now.
So where are you looking to invest?
Midwest and the Southeast. Those are two areas that we really like because they're great value propositions there. And you really want to focus on states that are landlord friendly. And that's one thing that I always say to investors that say, hey, we want to invest in the U.S., not to think that the U.S. is, one overall homogenous area. They're divided into different states. There's employer-friendly states. There's employee-friendly states. Same thing for tenants. Tenant-friendly states and for the friendly for the tenants. So you want to look at that. There's a few states that I like. We have some investments in Missouri. We have some investments in Indiana. There's parts in the South that I'm starting to look at. They have some great propositions there. So there's a lot there. It comes down to where you want to do. And also, we don't want to also just put all our eggs in one basket, not all in one city. We want to sort of divide it up. And I think you have to look at those indications. You have to look at macroeconomics overall. Where is the money going at? Alabama's got some great things going on with opportunity zones, especially with tax reforms that's going on there. So you have to really look at that. And you also don't want to be in positions where, let's say you're into a city and like a third of the city's relying on one company. You don't want that either. Really why I like Indianapolis. That's one thing that sticks out of my mind. I really want to get into there. There's some few things I need to wrap up for going there, but it's a very diverse economically. And I remember when I was there, a lot of people talk about 2008 during the so-called crash.
Yep.
But Indianapolis was still busy. The malls were busy. The restaurants were busy. because they made a conscious decision, which was very radical in the Midwest, in the Rust Belt, was that they were going to invest into industries outside of the automotive industry in the 90s. At that time, the 90s was booming. You remember the big SUVs and cheap fuel. I remember getting gas like for 80 cents a gallon, right? It was a different time. And, but 2008 was not much in Indianapolis. In fact, a lot of parts of Indiana, where I'm from, actually, I didn't mention this, but from Fort Wayne, Indiana, property prices didn't go down too much. They went down a little bit, but nothing to the levels that you would see like in Vegas or these other areas out there in the U.S. So it had some insulation to all that, and I think that's where I want to go to where I want to invest in the future. Just speaking on just from a foreign perspective, coming to Ontario, I was amazed on how different the housing rules and the rental rules are out here in Ontario compared to where I came from, the Midwest. So that was interesting as well. And that's also another reason why, too, if there's any investor that's here that's at a point of saying, you know what, I'm not getting good cash flow in Ontario, look into the U.S. and look at those landlord-friendly states. I think anyone can be blown away how hospitable those governments are.
Yeah, and we should define too what a landlord-friendly state is. At least the way I look at it, it's states that have, if there is a judgment, the judgment is most likely, or basically it's all written to go in the favor of the landlord, and they're usually contract states, meaning that the rental agreement is looked at like a contract, and by you not paying your rent, it's breaking a contract. So that you can go after them for the contract thing. You have a contract to pay this much. Did you pay that much? No. Yeah. Well, then you're in violation of a contract.
Yeah. No, exactly right. There is a lot of value put upon that contract, more than the value for that piece of paper.
Yeah.
And that's the biggest thing there. And you sign a lease, and let's say you bug out. They'll come for you, and there's a threat of garnishing your wages. You go to another state, and you're obligated to pay that full amount for, let's say it's a 12-month lease, you have to pay that full amount, and that's something that is looked upon very strongly down there. I remember this when I went to Purdue University in West Lafayette. When we signed that 12-month lease, we had to owe that 12 months, regardless if we lived there, we moved out, and it was part of our credit check, and that would follow you around. Right now, what we are focusing a lot is on B level properties. As the listener may know, there's the A, B, C, D levels of properties. But right now, we're doing B levels. It doesn't mean that we won't look at other levels like C level properties down the road. That's a good base for us. And we look at a few things. Again, like I mentioned to you, it's property prices in those areas, the macroeconomics of those cities. I mean, I mentioned a few states, but I like to mention cities more. Like there's Indianapolis, Indiana, Columbus, Ohio, Memphis, Tennessee. You've got Little Rock, Arkansas. You've got, Huntsville, Alabama, even Birmingham, Alabama. You got Kansas City, Missouri. I can go on. And those, Atlanta, Georgia.
Yeah. Jacksonville. Yeah. There's lots of places. Yeah.
A lot of places. Jacksonville's another great place. And so I look at those value propositions. I look at what are the market rates for those areas. And is it indeed a B level property? Because you may just don't look at a B-level property just at the price. You really have to look at the neighborhood, and you've got to do diligence, especially if you're out of state or out of country. You really have to look in there. But again, going to the point, macroeconomics are big. What are the big jobs there? Do people have jobs? Those individuals that are going to be your tenant that's going to live there, do they have a chance to having a job? Because let's say if you're buying a $100,000 property, $1,000 rent's a 1% rule. What I would say to a Canadian investor or an Ontario investor, don't look at it from $1,000 here. $1,000 rent in the Midwest and Southeast is a big chunk of rent. That's a big amount. So you've got to have a good job. And so you got to make sure, do they have a supply of jobs in that area? So that's a key thing. Then it's also what's your strategy of how you want to go about getting that property, right? Like, do you want to take a distressed property, put some active appreciation in there, and then hold it or sell it, whatever it may be? Or do you want to have a ready package like it's a turnkey? So if it's a turnkey, then you have to get a turnkey provider, but then you also have to understand you're going to pay a turnkey price. And you also want to make sure that in that proposition, what kind of turnkey providers are you looking at? Do you want a full-service turnkey provider that has items at the front end and then also will support you in the back end being like property management? Or do you want to sort of split that up and then get your own separate property management? That has to come down to your own preferences,
Exactly.
skill set. As I say to listeners, I talk to other. I have some turnkey providers that are them based on what their preferences are. Because some people, as you know, investors, they're very keen at certain cities. I mean, a lot of Canadians, and their first asphyxiation is like Florida.
Yeah.
They want to buy Florida, right?
Yeah.
And my wife as well. Like I told her, like Florida's great. Like places like Jacksonville are great, but I'm not buying a rental property in Miami as a simple buy and hold. I'll vacation there, but I won't go there as an investor for a simple buy and hold. So those are some key things there that I like to look at.
Yeah. You mentioned the B-class neighborhoods, C-class neighborhoods. In all honesty, a lot of the properties I was buying off the start were C-class, and it does have its, like, just if we're going to sort of rip down in sort of the differences and the benefits of both, the C-class tends to have higher cash flow. You'll get above the 1% rule, but you're in sketchier neighborhoods, so you're not going to have the same appreciation even, right? And a lot of times we don't have the same thing in Canada because our schools are the same for if you want to live in the worst neighborhood or the best neighborhood, and our neighborhoods aren't that bad. The worst neighborhood isn't that bad, but that's a big dictator in the States, and renters especially, because they can move around, are going to want to live in the good school districts, in the neighborhoods that appreciate the best, and the teachers are going to want to work at the best schools, and it's going to be around the A's and B's is where that's going to be. So you will have a different level of tenant at C, but there's different cash flow, but it's also a different way to diversify. You could buy both types of property and get the cash flow from one and the appreciation from the other, right?
Yeah. Oh, I definitely agree. I mean, part of my roots, as I mentioned to you, being a Punjabi immigrant, my parents coming from Punjab, and that's in India. Anyone that doesn't know that, coming to the U.S., we started in a C-level neighborhood, and that's where I grew up, and so I was very familiar with that and the attributes of that neighborhood. But I also, as my parents, then we moved, we went to a B-level, and my parents tried the attempt of trying to rent that C property, that original property. Now, the things they did back then, they were, I would say, a lot more amateur. I mean, there was less knowledge back in those times, but I saw some of the pitfalls there. And why do I bring that up, Glenn, is that I think C-levels work. You just have to have a really good system and process of how to get your tenants are there, right? But, for us right now, we're looking at B-levels only because we know that we feel that there's a little bit more consistency when it comes to our rental income. We know we'll get a rent check every month. Yeah. But you do need to sprinkle a little bit and have some opportunity. For example, you could take a distressed C property, put some active appreciation, go to good quality tenant, and you can make some good returns there. So there are definitely opportunities, and there's a lot of opportunities in those areas. And also too, it's always at the end of the day, it's your risk appetite, right? It's for any investor. For a lot of listeners here, especially if there's a lot of listeners from Ontario, is again, I try to really big strive in my conversations as wealth strategy, your portfolio strategy. And so when for example, I say U.S. investing, I'm not trying to say do all your future 100% of all your investment transactions in the U.S., but try to look at that as an opportunity for putting that in there from your income flow. And I think one other thing that I would want to mention, I alluded to a little bit about wealth destruction when it comes to taxes, is that when it comes to taxes, even if it's in the U.S. and Canada, a lot of people don't realize that 90% of the tax code is designed for you to legally, and I say that again, legally, prevent yourself to pay taxes, and real estate's a great vehicle for that. And especially in the U.S., there's a lot of great things going on with the latest tax reform from a tax perspective. And so for investors, they really need to look at that and add that diversity into their market. And as you would know, Glenn, as your podcast has been created just to invest in the U.S., there's a lot of foreign activity, like in Europe and to Australia and Asia, that wants to invest in the U.S. And there's some main reasons there. So I think as Canadians, they're in a very good privileged position, especially the ones in Southern Ontario, to use that equity and invest in the U.S. They'll find it's not as hard as they may think it may be. So that's what I will leave it as. So.
That's great. That's great information. Paul, if someone wanted to get a hold of you, what's the best way to track you down?
I have an email. I can maybe give it to you, Glenn, and you
Sure.
can post it.
Sure.
And we'll go from there. But yeah, it's Real Estate Freedom. So I'll get that information out to you.
Appreciate it. That's awesome. Thank you so much for your time, Paul. That was great.
Yeah, thank you for having me, Glenn.
All right.
Appreciate it.
Thanks.